All right, thanks for that, Karanya. Let's also get you a quick market check. The Nifty index is just about holding up in the green for this morning. The mid-cap index as well is also just about holding out. Your autos and the bank indices, however, are slightly in the red just now, flirting with that line. They could turn positive. I'd say given the weak global handover, it's pretty good how we're holding up. Selective stocks as usual. We have Azeel, Bajaj, Finserv and Finance and Infratel, a power grid that are all doing well today. On the flip side, you have an Adani Ports, an ONGC, a TCS, an LT or a Shree Cement that aren't doing rather well. On a holistic basis, 27 out of the 50 Nifty stocks are currently advancing, while 22 are declining. But let's also get you a feel for what's happening with the COVID-related headlines for this morning. And we're going to begin with the fact that global cases have crossed 84 lakh, with over 4.5 lakh people now dead. Cases in India have crossed 3.66 lakh, with around 12,000 dead. We did have our largest surge in cases recently. India's recovery rate has improved to 52.95%, so our deaths are relatively lower compared to the rest of the world. Karnataka to observe a mask day today, so that's something good coming out of there. Delhi collects 16,000 samples in the last 2 days, so it just goes to show you how quickly they're testing. The death rate has jumped from 2.8 to 3.4%, so at the same time the overall death rate seems to be climbing. Maharashtra government caps walk-in lab tests at 2,500, so there is some limitation as well being introduced by us here. China reports 28 new virus cases, so not a large number, but definitely hints of a second wave. Use dexamethasone under medical supervision, says the WHO. So we saw them, suggest hydroxychloroquine and recall that. They're making sure this time this doesn't go the same way. And finally, no plans to reimpose lockdown as of now. Those are words coming from the US President's office, Donald Trump. So it looks like the US is going to be alive and kicking as far as the economy goes.
All right, let's welcome in management then. You have Welspun Corp joining us right now to talk about what really aided their turnaround in performance, and will the margins trajectory be sustained over FY21? We'll help the management answer all these questions and more. Vipul Mathur, MD and CEO of Welspun Corp, is with us. Morning, Mr. Mathur. At a time when companies are struggling to manage a turnaround performance in Q4, can you tell us what really pushed your performance this time around despite all of the disruption and challenges because of COVID?
So thank you for having me on this call. It has been a good year for us, and we have tried to make the most of it. It has been a sort of a very exemplary performance, not only for the full financial year 19-20, but also it has been a very consistent performance over quarter on quarter, if you see that. We had a robust order book. We had capitalized upon that order book. We have executed it well. We have moved in a very disciplined manner, with a very focused manner, with a very cost-conscious manner. And that is what is resulting into this performance in the quarter 4 as well as in the financial year 19-20. I'm very pleased to highlight that in this financial year 19-20, this has been an year where we have done our highest production ever of 1.6 million tons of pipe. We have done the highest ever sales in the history of Welspun of 1.5 million tons. And we have also had the highest ever EBITDA of 1,284 crore rupees, which we have earned during this year. So it has been a great year, and it's as I said, it has been a very focused and disciplined approach which we have followed all through the year, and we are seeing the benefits of that now.
Right, Mr. Mathur, thank you so much for joining us this morning. This is Varun also joining in. Okay, so we understand Q4 and year-end had a really strong finish for you. On the margin expansion front, could you tell us some of the measures that you just spoke about in terms of cost-cutting or operating leverage that may have led to these margins? Also now, given what we're seeing in Q1 and Q2, how is this margin profile likely to change when demand may drop?
So, if you see, Varun, till Q4, everything was normal, everything was going absolutely okay, except for the last few weeks of the quarter 4, which was of March. So we did not have any significant impact around that. But as we moved in the financial year 2021, where we are seeing a double whammy, we are seeing the impact of COVID-19 and also a significant meltdown and a demand destruction in the oil pricing. Now, in that situation, we had very, very consciously worked around for our cost optimization, our operating costs, our fixed costs, rationalizations, and align it to the new normal. So we have already done that, number one. Number two, and we will see the benefits of that coming it over the next 4 quarters of this financial year. They will definitely get reflected in the play. More importantly, what we also need to highlight is that we have an order book of more than 700,000 tons at this point of time as we speak, and which is fairly split across all the geographies in America, in Saudi Arabia, as well as in India. So, we still have an order book of 700,000 tons. We still have 9 months to go. We are still seeing a traction coming into the market for some buying. It is not that the buying has completely stopped. It has gone down, but the buying is still happening. We are very hopeful to capitalize upon it. And on top of it, when we have rationalized our cost and align it to a new normal, I am sure the margins. Our endeavor is to continue to protect our margins as what we have been able to do in the past.
Okay, that's very heartening to know. But do you foresee any issues in Q1 as well? Now that the quarter is almost over, if you could give us some hint of how things panned out, because the peak of the lockdown essentially happened in Q1.
It did impact it. It definitely impacted all our facilities across the geographies. Had to go into a sort of a mandatory lockdown because of the government directives. But since then, they have now come back. And as we speak, all the facilities in India, in Saudi and America are fully operational at this point of time. So there was an impact of a few weeks, which definitely has there. So our margins and all those things would slightly be lower on the lower side of it, or the sales would slightly be on the lower side of it. But we still have 3 more quarters to catch up, and I'm very sure that we will be able to do that. So, the good part is that you still have an order book, a backlog to execute. Only what would happen is it is slightly getting deferred from one quarter to another.
Right, Mr. Mathur. All right, let's also get one specific question in on one of your JVs in Saudi Arabia. Now, there was already an order backlog we're given to understand of around 2 to 3 quarters. Now, is this going to be further delayed, and what is the traction in order activity to increase there?
So, we still have close to 200,000 tons, more than 200,000 tons of an order backlog in our JV in Saudi Arabia, and that will see to us that we are absolutely occupied for 2 more quarters, if not more. On top of it, we had participated in certain projects in Saudi Arabia, and we were the lowest bidders in those projects, 2 of those projects. And because of this COVID situation, and because of the lockdown happened, the award decision got postponed. We are very hopeful that once everything will open up, those award decisions will come in place, and once those award happens, so that will bring a further business continuity for almost 4 more quarters, 1 more year for sure. So Saudi Arabia for us looks fairly robust at this point of time.
Mr. Mathur, could you also give us an update on cost optimization that you've seen this quarter? Now, as we move forward, will that be your strategy as well? Are you cutting back on capex as well? If you could shed some light on that.
I mean, when I say cost optimization, it has been across the board. We have been able to rationalize our fixed costs. We have been able to rationalize our operating costs. We have been able to significantly cut down our capex. We have completely put a freeze on any new capex except for the maintenance capex or the mandatory capex which you have to do to finish off your earlier projects. So so all those factors put together, I mean, there has been a significant work which has been done over the last 2 months, and I'm sure that we will see a quantum benefits coming out of that in the subsequent quarters for that. They will definitely get reflected into our financial numbers too.
Okay, Mr. Mathur, it was great chatting with you. Thank you so much for talking to us about your plans going forward and how the quarter transpired at Welspun Corp. Moving on from one management to another, we have Manish Gulati, the Executive Director of HEG, joining us right now on the show to talk about their performance. Mr. Gulati, hi. Despite Q4 revenue being more or less at the same level on a sequential basis, there's a huge EBITDA loss in Q4. If we compare it sequentially once again with the break-even of Q3. So is it the high cost inventory usage that has hurt your results more than the lockdown?
You see, in our kind of business, where it takes 2 months to make our product, some of our products, and even 5 months or 6 months to take some of our products, we always carry a lot of inventory. So there's a WIP and there's a raw material, and that raw material is also imported from US, UK, Japan. So there's something on the way, en route, and something between Mumbai and Bhopal, and then in our silos. So we are always working with this kind of an inventory of, let's say, 2 months at site, 2 months under process, and again 2 months or 1 month of finished inventory. So that is why, because of the drop in electrode prices and the drop in prices of raw materials, we had to take this hit of NRV. We had to revalue the inventories we have. So that is why, for the quarter, we took this for 427 crores. And for the year, it was 459 crores, which is what you see in Q4 and the annual results.
All right, so this is Varun also joining in. So given what you just said, what was the hit you took in your NRVs in both the UHP and non-UHP segment?
See, if you look at the last 3-4 quarters, UHP pricing has been coming down quarter by quarter. So I will not be able to disclose the price, but if I talk in terms of capacity utilizations, you can make out on your own. Let's say in Q4 we manufactured at the rate of, let's say, 50%, and sales wise we were in the mid 60s. That is what we sold, and hence this turnover of net sales of 374 crores. But the pricing is definitely coming down quarter by quarter. And for us, it is not an absolute electrode pricing. It is the spread between the electrode pricing and the needle coke pricing.
So, Mr. Gulati, it looks like the COVID lockdown has not hit you that bad in Q4. What capacity were you operating at? And given the fact that utilization levels had anyway been falling in FY20, if you could give us some sense of where this is headed?
Yeah, in Q4, the impact of COVID was not much. And let me confirm what you said. In sales-wise, our capacities were in mid-50s for Q3 and mid-60s for Q4. So actually, the Q4 sales tonnage in terms of tons was more than Q3. So we are not impacted as much due to COVID in the Jan to March quarter. We may have some impact in the April to June quarter, because the lockdown itself was announced on 24th of March, as you know. So by the time a large part of quarter was over.
Right, and then, so in that case, what will be the impact in Q1? I'm sure there'll be some lockdown impact for this quarter.
See, Q1 we expect it to be around working at around 50%, because there was a clear 1 month shutdown. So we try to make it up, but we'll be around 50%.